All right, welcome everyone to today's webinar. Sorry we're getting started a couple minutes late, but Justin and I were wrapped in a great conversation just to make sure that this thing goes outstandingly. We're going to get started in about 90 seconds, so settle in, grab that cup of coffee, run to the bathroom if you need to, and we'll get started very, very soon. All right, we'll call that 90 seconds. So thank you everyone for joining today's webinar, Opening Doors to Home Ownership with a Self-Directed IRA. This is featuring Jesse Cootie of the Lucky Group. Before we get started, we're going to do um, the disclosure that our lawyers definitely demand that we do. So this presentation is for educational purposes only. Camel Plan doesn't provide any endorsement of any particular asset or provide any investment advice. We encourage you to do your due diligence and go seek out the advice of the appropriate professionals to be able to before making any investment. So a housekeeping issue, we will be have the chat closed. Oh, excuse me, I'm having some technical difficulties. We'll have the chat portion closed during the webinar, but you'll have the Q&A section open. So please ask your questions during the presentation, and we'll definitely answer them as we see those come in. So without further ado, I'm going to stop sharing my screen, Jesse, so that you can share, and I'll turn it over to you.
Perfect. Thank you. And good afternoon. It's good morning where we are, but good afternoon. And welcome, everyone. My name is Jesse Cootie, and I'm the founder and CEO of the Lucky Group. I want to thank everyone for joining us today at this investor webinar. Over the next 25 minutes, I'll walk you through how the Lucky Group is transforming access to homeownership for millions through our flagship investment vehicle, which is the Lucky Fund. We do business as Dorley LP. We'll talk about that more as we go along. We'll discuss the problem that we're solving, which is the size of the market, our unique strategy, and most importantly, the investment opportunity we're offering to accredited investors like you. A little background about myself. I've been in real estate for 17 years now. Previously have had about $60 million in real estate through rental portfolios and flips, and doing that before we launched the Lucky Group. Some of the things I saw firsthand was how many hardworking Americans were being left behind by the outdated mortgage system. That inspired me to create a platform that not only unlocks homeownership for millions, but also provides strong asset-backed returns for investors. And as you'll see in the next slide, this is our offering. We're raising $10 million to scale our originations. And here's what that means for investors. We are offering a preferred return of 12% annually, distributed quarterly. Our target is 15%. We're currently hitting 16%, so we're hitting our target. The term is 3 years. Our active markets that we have currently and we're licensed in is Texas and Florida. We are expanding to 7 additional states in 2026. We're already working on those licenses. This is open to accredited investors only. And we can go through any questions that you guys have along the way. Our mission, it's simple but powerful. It is to democratize homeownership. We believe the process should be fair, accessible, and rewarding, not just for borrowers, but for investors also. Our vision is to make homeownership achievable for those who are overlooked by traditional lending systems, while building a socially driven and profitable investment ecosystem. On the next slide, you're going to see this is Robin. I'd like to introduce you to her. She earned a six-figure salary. She was a perfect, ideal renter. She rented for years. She had a perfect history of rental. She could prove it. She went to try to purchase a house through conventional lending. Within 12 minutes, they said no. They declined her. This is not an isolated case. It's the reality for millions of people. And this is why we do what we do. We see economic trends are tightening up on mortgage standards more and more each day, which only increases the pool of qualified but excluded buyers. This creates a huge opportunity for alternative financing, especially owner financing, which bridges that gap. The Lucky Fund is accessing this and untapped 175 billion. That's with a B, 175 billion in an addressable market. We focus directly originating owner finance loans for qualified borrowers. This approach allows us to do several things. One, leverage a time-tested strategy modernized with technology, delivering both financial and social returns, mitigates risk through a proprietary model that creates collateralized notes that can be sold to the secondary market, and solve a scalable challenge that have historically limited this space. We believe that a competitive advantage that we have 5 pillars that we kind of live by. We've built a borrower deal flow, a built-in borrower deal flow, control from acquisition to exit, collateralized and insured notes, tech-driven platform powered by AI and fintech, and a socially driven mission. Together, these create a system that's both profitable and impactful.
And Jesse, can you elaborate a little bit more on that slide? Because I know I personally have wanted to understand more about the different entities that you have founded, represent, and run. Can you talk a little bit more about that and how they play into this advantage?
Yeah, absolutely. So when we talk about the built-in borrower deal flow, we have a fintech platform that we are currently developing, and it's, I think further up in the slide we talked about Dorley LP. That is our fintech platform. We are going from application to keys. That means you could sit on your couch and buy a home. Of course, you want to get up and go look at it. We do all of that for you through our fintech platform. So we are able to underwrite, which we have very strict underwriting standards that we do on each of these originations. Also, we talked about the secondary market. The beauty of what we do is we do not hold these notes for a length of time, so it mitigates our risk. Just like all of the rest of the secondary performs, we purchase, we sell to our borrower, then we take that note and we sell it on the secondary market, our takeouts. So it's recycling of this fund, and it continues just to grow and grow. So hopefully that answered your question.
Yeah, it did. Thank you very much.
Yes. So some of the benefits that we like to also talk about are the ones that I believe most investors are very interested in. That's for the ability to invest through self-directed IRAs with Camaplan is a key advantage. One being tax-deferred earnings and growth, access to real estate without direct ownership and the headaches. I know those personally from the almost $60 million. That's why we love this program, is because you don't have those headaches, but you're still able to receive the returns. The depreciation and K-1 tax benefits. Another one would be the investment diversification and the estate planning opportunities, and then just natural inflation hedge. You're not just investing, you're protecting and growing in your retirement wealth. At the Lucky Group, our strength lies in our people. Myself as CEO and founder with over 17 years in real estate and alternative financing. Our co-founder and COO, which is Hannah Cootie. She's an award-winning operator and strategist. Doug Rose, he's our CPO, helping build Dorley and develop. He is a fintech leader who's helped scale and start up other unicorn status companies. Unicorn status companies are ones that reach over $1 billion, and he's been able to do that in 3 companies already. And then Brian Hill, he's our Chief Capital Officer. He's got over 20 years experience in mortgage and finance and the capital and secondary markets. We believe that this team combines real-world experience in finance, real estate, and tech, and allows us to scale, as well as we have some fantastic advisors on our board. We like to say we're not just an idea, we're a proven execution. We have been named the most innovative company in 2024 by Best of Biz, Stevie Gold Award for Founding Team of the Year. That was fun. We actually went to New York to receive that. Featured in the Top 100 magazine and successfully launched the Lucky Fund with capital deployed and a growing borrower pipeline. All of this capital that we have is deployed immediately. And that's beautiful because our demand for our product is so high. These milestones demonstrate market validation and scalability. Just giving some time for anyone that has any questions. We do have some of our investors, they love to give feedback. And that's one of the things that we strive for, to have investors that love the decision that they made. One of our investors is Dale. He is a 30-year veteran in real estate. And he said it's a unique business model, offers both safety and strong returns, making it one of the best investment opportunities today. With that trust and confidence from seasoned professional, it speaks volumes for us. We're actually going to see Dale this evening. He's flying in, so that's going to be fun. The industry, it's overdue for disruption. Dorley provides a pathway to homeownership for millions who've been excluded. With macro trends like the rise of the gig economy and growing inequality in homeownership, the timing couldn't be better. And for investors, the opportunity has both financial upside and social impact. To recap, we're raising $10 million to expand originations with the preferred annual return of 12% and targeting IRR of 15% plus, secured by real estate assets. We invite you to join us as an investor to our strategic partner. As a strategic partner, you can schedule a call or access our investor portal directly through the links provided here. And we'd like to thank you for your time today and look forward to partnering with you in this journey. Guys, we are also, I don't know if anyone is in Austin, Texas, but if you are, we are having an open house this evening that starts at 6 o'clock and goes until 9. Again, that's why Dell is coming in. We have lots of LPs coming for that. It's going to be great. There'll be some cocktails. There'll be cigars. We have a cigar roller, and we have food. So if you guys want to drop by, we'd love to see you. And thank you guys again. Matt, thank you so much for hosting this event.
Yeah, well, don't run too soon. We're gonna get into some Q&A. So Aisha actually, she's asked a question. She's on the she's a regular participant, so I'm excited to answer her question. She just said, I joined late. Can you discuss your product and discuss what you're doing? And we actually had a few people who were coming in kind of a third of the way through. So I think if you don't mind kind of giving a soup to nuts explanation of what you do, and maybe if you want to go back on the slides and go back to that kind of case that you looked at, I think that would be a perfectly great place to return to if you don't mind.
The case, which one would
where you identified someone, she wasn't able to qualify for traditional financing.
Yes, Robin.
Robin, yep.
Yeah, absolutely. Well, thank you guys for joining. Those who joined a little bit after, we certainly appreciate it. And yes, so if I were to just kind of go back through some of this just quickly and on a, a little bit less wordy, I could certainly do that. Before we go to Robin, we'll go to Robin here in just a moment. So what we do, I'm Jesse Cootie. I am co-founder and CEO of the Lucky Group. What we do is we have a fund, we have the Lucky Fund, and we use that fund to originate owner finance notes. We then take those notes and sell them on the secondary market. So we do not hold the notes. It lessens and mitigates the risk of holding these notes for long term. We're able to recycle the capital and therefore get the returns that are desired. On the current slide that we have here, this is Robin. We underwrite very specific terms. We make sure that they fit in a box, but it's a little more forgiving than conventional lending. And we do that because we understand that there's a large number of our borrowers are actually 1099 and gig workers. As we know, that's a growing part of the market. There is, I think it's 20% of the market is the numbers that's out there right now. So conventional has kind of left them out. We invite them in, and they have proven over the last 2 years to be a very healthy and worthy of being able to buy homes. Robin was one that her income was over $100,000. She was a perfect candidate. She rented for years and years. And Robin was a perfect tenant in every way. She went and applied for a mortgage, was turned down in 12 minutes. And she came to us, we approved her, and now she is the happy owner of a new home, along with her family. We get to see that with a lot of our borrowers also, as they have families, they have children, they have been renting for a long time. We have the privilege of being able to see them walk into their house for the first time with their family, usually with tears, because this is the first opportunity they've had to own a home. That's what drives us, and that's why we get up every day and go, let's do it again.
Beautiful. And sorry, if you're going to keep going, I don't want to interrupt you, but I think if you want to kind of talk about the performance of the fund so far, and we have a couple of other questions that came in that we can get to, but I think if you want to talk about that too, for anyone who missed it earlier.
No, let's share, and please go to we're going to go to the slide with the fund performance. Keep going. That's up close to the front. So our offering, there we go. So the offering of the fund is $10 million. We do come in at $50,000 tranches. So anything 50,000 or more, that's the minimum. Preferred returns are 12% annually. Those are distributed quarterly. The IRR, our target is 15% plus. Currently, we're hitting 16%. The term is 3 years, and our active markets are Texas, Florida. We are expanding to 7 more in 2026, and it is accredited investors only. Did that help, Matt?
Yeah, that was great. Thank you. So we had a couple other questions come in, and this participant asked multiple questions within their questions. So I'm going to break them up. The first part is, what is the time frame to achieve the 15% IRR? So I'll just start with that one first.
Sure. So the 12% is paid quarterly. It's paid, I'll start with this. The 12% is paid quarterly, and that is paid out following the quarter you invest. So if you invest, say you invest now, we're at the end of the quarter. So your first payout of your 12% return on your capital would be January 1st, right? Because we're at the end of third quarter. You invest third quarter. That means fourth quarter is your first full quarter. You don't lose the third quarter. you start accruing, but you don't get paid out until January. The 15% or wherever that may fall, if it falls at 18 or 20%, that is accounted for at the end of each calendar year and then adjusted. So you're paid out, you would be paid out in January for any adjustments beyond the 12%.
Okay. Thank you very much. And so the next part of the question was, if the investor is receiving 12% annually, what is the interest rate for the borrower, and how is the 12% annual return achieved? And I think if when you're talking about the interest rate to the borrower, if you want to expand a little bit on any of the other loan terms like leverage metrics and things for the loans, that'd be great.
Yeah, absolutely. So what makes this work is several things. We're not charging absurd interest rates. What we do is our metrics start at 2 points above prime. So if right now prime is 7.5, our metric starts at 9.5. And it's adjusted accordingly depending on their DTI. One of the absolute major things, by the way, we follow all of regulation, right? We follow RESPA, we follow all of the federal guidelines and state. By doing that means we have to make sure their ability to repay, that's number one. They have to show ability to repay. Which goes into a lot of things. That's DTI, that's employment, that's income. All of those things come into focus whenever we're talking about ability to repay. So we have to document that. We have to show that in the right ways. We are not charging 12%. How do we gain 12 and 16 and 18%? We do that by turning the capital, right? So this capital is used again and again and again, and then we sell on the secondary market for above what we purchased for. So an easy example would be as if you had a $300,000 note. What are we selling that for? We're not selling it for $300,000. We're selling it for above $300,000, whatever that may be. Commonly, you're selling for between 4 and 5 points higher. So you would be 4 to 5% more. And then that's what also helps with the additional returns, right? So we're not charging the borrower, 12, 15%. We don't do that. I think the highest we've ever charged was a 10.3 was the highest we've charged. But again, when interest goes down in the market, so when we start seeing the prime go down to say 6, then we'll be at our starting point will be at 8.5.
Great. And then this person also asked, there are several non-QM lenders in this space that can help borrowers who do not qualify for a conventional bank loan. What differentiates your company from these non-QM lenders?
So these non-QM lenders still have a minimum FICO. The best thing that could match to us would be a bank statement loan. And that is, it's all controlled by FICO. So we look at someone's situation. I'll give you a scenario. We had a doctor, a surgeon. He had been over 20 years, and he had, prior to COVID, he had an 820 credit score, and he's always had a great credit score. He pays everything on time. He took his freedom and decided he was not going to take the COVID shot. And because of that, he lost his job. He could not get a job at any other hospital at the time. He lost his home. We look at common sense situations like that, and we understand things happen, right? Things outside of control. When that happened, his credit went down below what anyone else would lend to him. We looked at his situation and didn't just look at a credit score. So we do that with all of our borrowers. And when we did that, we could lend to him just simply because he was restoring his credit. He's extremely, he's someone that he pays back. So that's the difference between us and the non-QM. Is we look at it and we make it make sense to what we're loaning to. But we still have our underwriting that we follow, right? It just goes a little bit deeper than what the non-QMs do. Plus your non-QMs, they charge other fees and other things that we do not. So that kind of helps as well.
Excellent. And then same participant asked, do you lend to small residential builders?
We do not. We do not do any investment type lending. This has to be owner occupied properties.
Perfect. A question I had was, when you're talking about the loans that you sell on the secondary market, talk to me about what your buyer looks like, what the distribution channels are for those loans.
Yeah, so we actually, I think about a week ago, yes, it was a week ago, we just received approval on MI. Some may know it as PMI. If you have a mortgage and you did not put 20% down, if you put 10% or 3% down, you have PMI until you reach that 80% LTV. Private mortgage insurance. I'm going a little off here, Matt, but it'll all add up to the question you just asked. So that's private mortgage insurance. You'll see that on your monthly payment that you make to your mortgage. We just were approved for that. So if it tells you the strength of our origination and the strength of our notes, we did get that. Obviously, they only go down to a certain FICO, but we did get approved for that. So our underwriting is very strong. What that looks like is, what that means to secondary is that means our notes are more valuable. That means our secondary is willing to pay more, which to an investor, what does that mean? That means your investment goes up in the fund and everyone earns more. So that is on some of our notes, but what the secondary market looks like, if it was conventional, just to explain secondary market, conventional secondary market, FHA, any of those types of loans, it goes to Fannie and Freddie. I'm sure if you watch the news, you've seen a lot about Fannie and Freddie lately. Those are what we call secondary market for conventional loans. Fannie and Freddie, they buy your notes and then they send them off to pension funds and those fund areas. Ours looks very, very similar. It's just not Fannie and Freddie. It is other very large funds, billions and billions of dollars in funds that buy these notes and that want these notes. They love owner finance notes, but normally they find the regular owner finance notes that someone did. They had one property and they want to try to get some cash back out of it. So it wasn't set up right. It wasn't underwritten properly. Maybe even it wasn't in compliance, because it doesn't have to be if you only do less than 3. We do ours fully compliant. We underwrite them, very strict underwriting. We hold to those, and secondary loves our notes because of that.
Perfect. So we have some more questions that came in. How long has your team been in the fund business, and what's the history and performance of the fund? So I guess more about like the track record and how long it's been going on, as well as how many transactions completed under this model with this company.
So I'll answer that in a couple of ways. One, we started this in 2023. And when we started, we decided that we would do it in steps, right? So our goal was the fund. But before we created the fund, we wanted to make sure, okay, let's make sure we understand exactly how we want to do this and make sure that we're compliant. So we started with individual investors. Strangely enough, Dell was our second individual investor. Dell is a huge investor. He actually has 2 funds himself. So he came in as the first investor, and what we did is we had them, they purchased, but we did all of the work, but they were the ones actually purchasing the notes. And we would purchase no more than 5. That was our limit. And they held the notes. They had the notes. They were responsible for it after we did all of the origination, setting it up, purchasing it, leveraging the note. It was set up, they were earning somewhere between 20 to 23% is what they were earning individually. We even had some at 27%. But it was the way that we leveraged the notes. We only wanted to do that for a short period of time. And that was basically to prove it up, to say this works, beautiful, now let's go to the fund. So we did that 23, the last part of 23 and all of 24. The last, I would say 4 months of 24, we began setting up the fund. The fund officially went live January of 25. Once it went live, we brought all of those individual notes, we brought them into the fund. Dale put all of his into the fund. He had, I think, a little over $300,000 that of note, not of the notes, but what he had invested in the notes. And we were leveraging that by, he only had 20% in it, is what we leveraged that with. So he had 300,000, that was 20% of it. So we brought them all into the fund, not just Dale's, but all of the investors we brought in, all but one. And those are performing. They're still in the fund. They're performing currently. We've originated a little over $10 million in the fund is what we currently have originated. And right now it's performing at a 16%. And with us recycling the capital, this will go up. All of our models showing this going up. I'm hesitant to say what it is just because that's a dangerous realm to get into, but we do know it's going to go up from 16%. Hopefully
Great.
I answered the question clearly enough.
Well, it raised a question for me. So you said you were talking about the evolution of the business of proving the business model and how investors were investing into the notes directly as opposed to into the fund. And you mentioned that the notes came back into the fund and they're performing. But I know my understanding is that that the notes get sold onto the secondary marketplace. So are some of these original notes still in the fund, and then new notes that are being originated are the ones that are going into the secondary marketplace? And can you kind of clarify that for me?
Matt, I think you hit that on the head, but yes. So the original notes, we held those in the fund. What we did is we bought those from the investors. Well, we credited the amount that they put into the notes into the fund so that they get the returns quarterly. We did hold on to those funds, however, those notes. However, we are in process of actually selling those notes as well. But yeah, we do not hold any notes currently. Sorry, let me back up. Currently, we have those, but we are not putting any new notes into the fund just for a short period of time, which is usually about 30 days, which is what it takes to transfer them into the secondary market. So all new notes being originated go to secondary.
Perfect. And then another question was, what are the expected investor risks? We, speaking on behalf of the participants, potential investors, what are the expected investor risks we should be considering?
So there's always a risk to investing. The risk here, again, we mitigated prior to doing this. I would say the risk is obviously a default on a note. We have not had a default inside our fund. Knock on wood, right? We do expect defaults. Even conventional has a 2% default rate. So we expect a default at some point if we were to hold, but we got away from that model. So worst case scenario right now would be as if we had a note that was not sold on secondary for above par. Above par means earlier when I spoke about a $300,000 note, if we got 290,000 and we were to, we call it take a haircut on $10,000 of that note. That would be our worst case situation now, is to not get above par. We understand what our underwriting guidelines are. Secondary does as well. We know where we need to be to sell these. But in a case, we're not saying that mistakes can't happen. So that's the biggest risk, but that can also be made up over time, right? That may just mean instead of making a 16%, we now made a 15%, right? Until we make that up next quarter, just by recycling more. So that's our biggest risk.
That's that. I think regarding that, that risk specifically, you mentioned earlier that the target is to sell the loans off within 30 days. Um, is that, I mean, candidly, are you on a 30-day, by 30 days, are you able to sell everything off, or what's that range actually look like when you're able to sell the loans?
It's 30 to 45 days,
Okay,
what we sell them. But that only impacts the return based on what we actually get, not for the timing.
got it.
Because
And then
we
go.
already, sorry, Matt, we automatically assume 45 days. So when it gets better, that just means everything goes up. We like to plan for, let's not be too optimistic. Let's be more on the lines of realistic and say 45 days. And then whenever it backs up to 30 or 35 days, that puts us in a better position.
You said that you started originating these back in 2023. How did you navigate that fluctuating rate environment to make sure that you weren't having to, find yourself selling at a discount to the secondary markets, or even, yeah, just even trying to find distribution for them in the first place?
So in 2023, we were not selling these on the secondary market.
All right. Okay.
The investors were holding them as individual. Well, they were holding them as an LLC, but they were holding the actual notes. So Matt, if we had Dell, and he had 5 of the notes, he had those, and we did have a servicer collecting, the actual payments every month, so he didn't have to worry about that. But he was still responsible for it. If they were to default, he was responsible for that part of it. We wanted to take that off of them, pull all those into the fund, which they loved, because now they were just hands off, they were done, and now the fund had all that responsibility, right? So we do the same here. That's why when we say, we hear a lot about rental. Rental is not hands off. You are going to have your hands in it unless you have enough to have someone actually manage. And for me, that number was 50 properties. And you still have your hands in it to some extent. With this, it is truly hands off. You don't have to worry about it. It's quarterly, you receive your distributions and you're done.
Great. And then my last question, and I don't think we have any more, so I'll ask it, is how is the fund making money? Is it primarily through origination points, or is it something else?
It is through origination. So what we do is we have a acquisition and we have a disposition fee that, because the fund itself, my apologies, are you asking the actual fund is doing this through the,
I'm referring to like you and the team. How
okay,
is the entity
so the
making money?
GP.
Yeah.
Yes. So the GP earns by the acquisition and disposition. So when we go purchase a property, we are then paid for that through the fund. When we dispo the property on the secondary, that is when we're paid for that. So we basically take 2 points for the acquisition, 2 points for the disposition. That is how we earn.
Okay, beautiful. I don't have any more questions in the Q&A portal, so I think we're about wrapped up. If you didn't see it, everyone, I added in Jesse's Calendly link so that you can schedule a call with him or someone from his team to talk more about this if you're interested. Jesse, I really appreciate your time and having a lot of discussion. I People have heard this before. I have a background from a private lender myself, so this is a very interesting opportunity to me personally. So thanks for answering all my questions as well as the questions of the participants.
Yes, thank you. Thank you so much, Matt, for having us on, and thank everyone for being here today. We hope to hear from you guys.
Beautiful. So again, if you have any questions for Jesse, definitely use that Calendly link that I put in the chat, and you'll also receive a recording of this in by the end of the week. If you are unable to find Jesse or the Lucky Group, you can always just reach out to Camaplan and we'll make sure we pass along contact information. Otherwise, we will see you next week on the next one and wish you a great rest of your week. Thank you, and thank you, Jesse. Bye-bye.
Thank you.